Welcome to the Rick Helps Real Estate Show. I wasn't here last Monday. I was camping up near the Cottonwood area with some friends at Dead Horse Ranch. It's a nice state park. It was kind of nice up there, but it's cold up there this week, so I'm not going back. Well, I might. But anyway, be sure and smash the like button because YouTube has done it again. If you hit the like button today, you'll increase your odds of winning the Powerball, which right now the odds are 1 in 300 million. So you say there's a chance. Could happen. 1.6 billion, 1.9. And then they always say, it's only 789 million after taxes. I'll take it. So this is going to be a busy week. That's why I put the thumbnail up there of the ping pong ball. So you've got the midterm elections tomorrow. Although elections never really change the direction of real estate, it will kind of mess with mortgage rates a little bit because, the mortgage market likes predictability. So this week, there's going to be a lot of unpredictability. And so there's going to be the CPI numbers coming out on Thursday, which will more than likely have a larger impact on the volatility of rates than the midterm elections. But that being said, it's just going to be one of those bouncy weeks. So we sit here and look now at, mortgage-backed securities, and you can see that it says that the trend is leaning towards negative. So it's bouncing around a little bit, and that'll bounce around a little bit more as we go through the rest of the week. Now, what we'll find, and this is what Pat was alluding to the other day, is it's not so much the rate as the fees. And the fees are going to be increasing and decreasing dramatically. And I agree with you, Sean. I think rates are going to go up all year. But when there's a lot of volatility, it's really hard for lenders to figure out, you're going to get a 7% loan or a 6.8, and it's going to cost you, $1,800 in fees, or it could cost you $10,000. So that's going to bounce around a lot. My advice to you is if you're looking for a rate, make sure you're looking for the rates and the fees, especially some of the online lenders that are out there. Their fees tend to run a little higher. They tend to surprise you with them down the road. So if you get a good rate you like by clicking on one of the online ones, ask them for the fees to get that rate and then compare that. I've seen people spend more than $7,000 and that they didn't have to. So you have to ask yourself, how long does it take me to make $7,000? How much time is it worth for me to try and save $7,000? So once you get that rate and that fee, then go to a mortgage broker and say, hey, here's what I got. It looks good. What do you think? Now they'll go back and look at several different lending products for you, depending on your FICO score and your debt to income ratio, and then find you a product that works for you and compare it to what you just got. And they'll do a soft pull on your credit, so it won't hurt you. It does not hurt you to shop around for rates and fees. People tend to get caught up in just the rate. Oh, I got a 6.9 instead of a 7.2. It's a winner. Lo and behold, you're spending almost $8,000 in lending fees to get that rate down to 6.9. So just be careful and be smart about it. And what we're looking at in the rest of the market right now is a typical seasonal pattern here going into the holidays. You can see that right here our listings are trending down, but that's what they're going to do. And they've done it year after year after year, right? Closer you get to Thanksgiving, the more they just start to creep down. And, people just back off during the holidays. That's just a normal occurrence. Now, that's a little painful for you if you got a listing out there. And speaking of listings out there, I do get a lot of questions, and got another one this morning from a loyal viewer. And that is, my home's sitting here. We've lowered the price. I don't know if my realtor's doing enough. What do you think? Well, I can't address that for you specifically because it would be an ethics violation. I can't say, well, here's what your agent is doing wrong, or here's what they're doing right. Sean's got a question here. How many listings do we have now? 20,600, Sean. It's just hanging right there. It was 20,650 on Friday. It's just, Tuesday is always when the listings drop. So we'll probably be about 20,200 on Tuesday. So we'll watch and see what's going on. But getting back to the other agents, it's a slow market. And so people are going to ask a lot of questions. Should I have an open house? He doesn't really want to do open houses. Should I lower my price any further? You kind of have to look at all the options. Open house traffic, though, right now, I will tell you, is dismal. I get on the Facebook groups on Saturday and Sunday. I look, and somebody always asks the question, how's your open house traffic? I've had one. I've been here since 10 o'clock this morning. I haven't had anybody. It's slow with gas prices being higher. Not as many buyers on the market. We only had 2,200 go under contract last 7 days. So it's dead out there when it comes to foot traffic. So having an open house, the odds of you finding a buyer through an open house has always been kind of slim, and now it's even slimmer. Marketing. What can agents do? How much exposure am I getting? So there's the best exposure you can get is great photographs. So you've got good photographs. You're one step ahead of the average listing that's out there. And if you've got a floor plan, if you have a 360 tour, again, you are above the average listing that you see on the MLS in this market. So that's great if you've got that. And then it boils down to price. The higher the price is, the longer it's going to take. It's always been that way, especially if you're up over $1 million. Used to be that was a 6-month listing, just would take that long to sell the home. But we got spoiled. We expected them to move in one weekend. The challenge is getting into the holiday season now. Traffic's going to be even lower, and you're going to say, I've gone 1 week and I've only had one showing. Well, one showing in 1 week right now in this market is probably going to be pretty good, because the buyers that are out there now are the serious ones. They don't want to be looking for a home coming up in the holidays any more than you want to be trying to sell yours over the holidays. So they're probably looking because they got a job transfer and they're moving here in January. So they're serious. So be patient. Your real estate agent is probably doing everything he can. There are some that aren't doing anything. The marketing that they can do is really kind of limited. You can do a lot of Facebook advertising, Instagram. You can put out videos on YouTube, although that's very ineffective. Nobody shops for a house on YouTube. They look for information, but they don't Google 3-bedroom, 2-bath home Gilbert. They just don't. And if you do, it's got 30 views. So, and then it probably sold last week by the time you found the video. There are some things that agents can do. One thing called a reverse lookup. You can look up all the agents that have sold a home in the past 6 months or 90 days in that zip code, and then send out an email blast going, hey, I don't know if you've seen this home or not. That can help. But there's a few tricks up your sleeve. Right now, though, as we look at the market, we look at the Cromford Market Index. This is demand, and demand sitting down here at 77.2. The supply is 82.2. And I point this out because I had put out a video the other day, and it showed this Cromford Market Index with a date at the top of October 1st. They just hadn't updated it. And so I spoke about these gaps here, that when you see a huge gap between the demand down here and listings up here, this means you're going to have severe price decreases. Conversely, over here, 2021, 2022, we had listings down here and demand way up here. So we had aggressive price increases. But right now, they're meeting in the middle. They haven't crossed yet. They're starting to. So are we going to see this type of a gap? The trends right now that we're looking at doesn't appear that that's going to happen. I'm not seeing inventory spike up as fast as it is here. It did here. Remember, as rates went up in May, inventory all of a sudden just flew up, but then it stalled. And it looks like it's kind of in that stalling mode. Bravo Man has a question here. He says, do you think increasing house listings next month is bearish? I started noticing in my area in Michigan. Typically, January has more listings come on board. I don't think we're going to see a huge spike, just because of the number of cancellations and expireds I've seen. It tells me that the people that were wanting to sell tried and failed, and so they just pulled them off the market and probably turned them into a rental, or just said, I'm going to stay here. So that's kind of the big question going into the first of the year that everybody's going to be looking at, is how aggressive is the our listings going to be in January? Because it doesn't look, based on what I'm seeing, like we're going to see a lot of homes all of a sudden show up. January is the month where that happens, but the problem is they're just not selling out there. Here's the contract ratio. We're sitting at 30.6. So it's taken a while for the homes to sell. Only 30% of you are successful according to this ratio. I shouldn't say 30%. This is just a contract ratio. From what I'm seeing, and I track the 7-day moving average, as you know, the yellow line are the number of homes going under contract over a 7-day period. And here's the number of new listings that are coming out. And it looks like new listings are climbing, but that's only about 100 or 200 homes. And they're starting to trend down a little bit right now. So the gap here is what we really want to follow. There was a huge gap that started back here in July where listings were way below new listings coming up. And that's when the price decreases started to show up. So we watch this. We get into January. Let's see how this changes. The interesting thing is that, and I don't know if it's a stat that really means anything, but you look at, 3,000 homes come on the market and 2,200 go under contract. That's 63%. So 63% of the homes are somehow managing to get a contract. And it's not an aggressive number by any stretch of the imagination, but if you're priced right and in a good location, it is selling. But the challenge is, what is priced right? I'll see things. I'm 40,000 below comps. Well, what's your comp? I mean, and then there's Zillow says, look, Zillow could not be more wrong in this kind of an environment because they look at past history. So they just look at the algorithm, what sold, how much, and they put together an average and they spit it out for you. Sean says, if selling goes down, rental prices go up. That would seem logical. It could, depending on the area. We are seeing a huge spike in multifamily units coming on board, and rental prices are starting to trend down, but not by much, like maybe 3 cents a square foot. So I think it went 140 to 137 in some areas. One thing I noticed, a lot of buyers still looking. I agree. I don't see prices dropping unless buyers stop buying and stop looking, maybe. At 2,200 every 7 days, that's a historic low for us. We didn't hit that until 2008. So we're there now. The only difference is in 2008, we spiked up to 58,000 listings. And the buyers that probably wanted to buy couldn't because they had foreclosures. They gave up the house. So the buying pool of qualified buyers was nowhere near what we have now. The problem we have now is simply affordability. I can buy, I just can't afford it. The house I want, that I want for $400,000 is still $500,000 with a 7% interest rate. I could have bought it at $400,000 with a 3% rate, but I waited. And then when I did jump in, I got outbid. So that's what's going on in the market now, is that people are saying that house I wanted, I was getting outbid last year. This year, the rates have knocked me out. Had one example from a gentleman last week, said, I was qualified for a $275,000 condo at the payment of about 4%. Now with rates where they're at, I only qualify for a $240,000 condo. What should I do? And I said, wait. There's no reason to jump in. You don't want the $240,000 condo, right? Just wait. And I know you're going to get burned on rent for a while, but there's no reason to panic and jump in and say, well, I got to get this done. So the market is not ripe for the number of buyers going down. The market is ripe for new listings starting to come on board later next year. In January, like I said, I don't think it's gonna strike. I don't think it's gonna pop up, but I don't see how buyer traffic can get any slower than it is right now, and it's pretty slow. If we look at some of the other indexes here, I'm going to try and pull up what's going on, and we take a look at by city. Remember, Fountain Hills at one point had an index of over 750. Definite seller's market, not a buyer's market. So anything over 100 is considered a seller's market. And these guys are barely eking it out now from Cave Creek, Paradise Valley, Scottsdale, and Fountain Hills. You can see where the bottom three here, Maricopa, Queen Creek, and Buckeye, have fallen off the map. Down down to 49.8. Sean's asking, do you think prices will ever come down to 2019 levels? Sean, I think if interest rates get around 8% and stay there, that could happen. What we need to look at, and I'm going to pull it up here, is let's take a look at what that really needs to look like. Let's go by, see if I can get list pricing here. And we'll look at a daily chart. Sometimes I end up pulling up the wrong one, so bear with me, folks. That's not the one I want. List pricing. Talk amongst yourselves. Active all areas. Daily chart. 2-month view. See what this looks like. This is the one. Okay. So here's list pricing. So right now you can see they're just kind of average list price per square foot's hanging way up here at 309. You got onto 2020 and they're 277. So that's a pretty big gap there to come down to for 2019. But prolonged inactivity could slowly bring us down there. We do know that the sweet spot in mortgage rates is 5.5%. If we ever get back to 5.5, the buyers come jumping back in. Why is there buyer traffic despite high interest rate? It should be lower traffic. This means people still looking to drop houses and have saved cash. They do. Some people are not sneezing at the 7% rate. And, we have, it's lower buyer traffic. I mean, there's no doubt about it. Take a look at this. See how the line's just going straight down? But 25% of our buyers are still cash. Some people have gotten lucky and sold their house in another state. We're still getting buyers from other states. It's getting harder for them to sell their homes in places like California. And, but they're still moving them, and they still have, look, people had a lot of appreciation from 20 and 21. So some people have got the money for it. And some people are doing 2-1 buy downs, and they're doing some, getting some contributions from sellers to help buy down the rate. So the buyers are there. They're just in slower numbers. And again, I'm going to say, that I don't see the buyer traffic getting much lower. What I see, where the numbers are sitting now at 2,200, with the number of new listings just kind of staying put, even if neither one of those numbers move, active listings will grow, because the houses that coming on are just not, they're not moving. So it's going to be a slow march to big inventory. And what I was about to say was saying that back in 2008, we had 58,000 active listings, and look at it today, we have 20,000. So we think, are we getting up to 58,000? Doesn't look like it. Doesn't look like it yet, but there was a hidden number behind that 58,000. And that is that there were 30,000 pre-foreclosures out there. So that's an inventory of 88,000 homes at a time when nobody could get a loan. They were in foreclosures. They were not going to be able to get a loan for 7 years. They just were stuck. So they were renting. And a lot of the houses were all torn up. Now, new home construction is doing well. Let me pull up and show you what's going on with that here for just a moment, if you bear with me, what we're seeing. And we got a question. Do you see housing starts drop? I haven't seen much drop in housing starts. They have slowed down. Here's the affidavit of Maricopa County. I'm going to try and get to this here. Let me see if I can make it grow. There we go. Make it easier to read. And I'll get my handy dandy magnifying glass while I'm doing this. New home totals, new home closings totaled 1,410, up 4% from October of 2021. New construction is doing well. Why? They have more incentives. Overall median sales price was 470, up 11.2 from October 2021. Now, the median sales price means there were just more that sold on the higher end of the market. We can see that new homes are still faring much better than resales, with a new record high median sales price up 2.3% from last month. New homes now represent, let me scroll this down, 23.4% of all closings. Resale closings are down dramatically, the lowest monthly total since January 2009. The median sales price has fallen 8.1% since the peak, which was in May, but it rose slightly during October. That's the interesting thing that's going on right now is we did have some median sales prices start to rise in October, and it looks like it's just from the high end of the market. So new construction is doing well. Why is that? Well, they're offering you some sweet interest rates because they've got all this cash that they can help buy down your rate. They're offering you incentives to go into the design center here, $50,000. So they're throwing everything at you but the kitchen sink. So people that are looking in home build communities, and there's a lot more spec homes now. So you don't have to get on a list and you don't have to wait and say, hey, do you think I can buy a new house? I really want one. Can you put me on the list? And I remember when they were doing that at one point down in Fulton Ranch, down by in Chandler. It was a lottery system, and this was in 2007. And I said, this is not going to last. And I am going to wait and get one of those homes. And I didn't. I should have. But people that got beat up in 2008, and I'm repeating myself, couldn't play. They couldn't play. Now there are so many people sitting back and waiting. And everybody's got a reason to wait. I'm waiting for rates to go down. I'm waiting for prices to come down. I'm waiting. Nobody's waiting because they can't qualify. They're waiting because they're waiting for their opportunity. And we know that if things get down to 5.1 and home prices go down to 10, it's going to be a game changer. Now, will rates get down to 5.1? I don't know. There's some good arguments that say that later on next year, the bond market may just start pushing back on the Fed and getting us to a point where rates will come down naturally. Again, don't know. It's a complicated business. Running at altitude here says a lot of people purchased past few years are now regretting it. Maybe, maybe not. I've talked to people that have got their house. They know that the equity is declining, but they love their rate. They're sitting at 2.9. And they're going, I'm at 2.9. I got a payment I like. I got a neighborhood I like. The equity is probably going to dip greatly in the next 2 years, but who cares? I'm in it for the long haul. I'm probably going to be in here 15 years. Once the kids graduate from school, I might think about selling, but in the meantime, I'm going to be paying down what I owe. The payment's not killing me. There's no urgency to move. The neighborhood's not, deteriorating. I'm not going to worry about it. So that's what I'm seeing. Now, there are some people that thought they could buy and they were going to sell in 5 years that are sweating bullets. Don't get me wrong. They're out there. But as a rule, I think people are pretty happy staying where they are, and you can see it in the numbers. I put that video out the other day showing that the number of cancels that we have. People they tried and they said, I'm out. I give up. So that's the market that we're in. Now let's watch and see what happens after the midterms. It doesn't matter which party wins. There's going to be movement in the treasuries. The Democrats win, the Treasury is going to move. I don't know which way. Republicans win, Treasury is going to move. What's going on in the governor's race? None of that's going to matter to the bond market. Those are all local issues. But overall, which party wins stuff is just going to add volatility. And then that party is going to happen on Wednesday, and the nervousness and anxiety or the celebration on Wednesday. And then Thursday, the CPI numbers are going to come out and everybody's going to go, forget the midterms. That party's over. So we're going to watch that here. Make sure and sign up for my newsletter. There are, 39 of you have taken advantage of that. I send it out every Monday morning at 7 o'clock. I don't spam you. You just get it. If you have signed up and you haven't seen my newsletter, check your spam folder. Thanks for watching. Take on the day and have a great week.